Efficient logistics, vast acreage, and reliable yields made it the undisputed export king. But by 2025, that dominance is under real strain. Record harvest forecasts, falling futures, and escalating costs have combined to squeeze American farmers as never before. Mexico's resistance to genetically modified corn has sparked a legal clash under the U.S. Mexico-Canada agreement, technically won by Washington, yet still unresolved in practice. And as the U.S. wrestles with regulatory friction, Canada has quietly seized the opening, promoting low-carbon and traceable grain as the new global standard. The era of automatic advantage is over. The competition now revolves around proof, not just price. The market turns. For years, American corn exports thrived on volume and efficiency. That edge is now uncertain. By late summer 2025, traders watching a short-lived rally quickly sold off as harvest forecasts surged. Reuters reported futures slipping from 6-week highs, even with strong crop ratings, as talk of record yields dominated market chatter. Margins are the real problem. Farmers face higher costs for fuel, fertilizer, labor, and credit, far above mid-2010s levels. Softer prices don't spell crisis outright, but they erode any financial cushion when export demand cools or basis values weaken. USDA data show sales fluctuating sharply, with Mexico, Japan, and Colombia rotating as major buyers, but no single market consistently holding firm. Meanwhile, global output is swelling. Germany projects a sharp rise in 2025 grain production, and Black Sea exporters continue shipping at full tilt. With more bushels chasing fewer premium buyers, the price war tightens. And for U.S. corn, compliance, not cost, now determines who wins the deal. Mexico's GM standoff. Mexico remains the United States' largest corn customer, making any regulatory dispute critical. In December 2024, a USMCA panel sided with Washington, ruling that Mexico's restrictions on biotech corn lacked scientific justification. The U.S. declared victory. Mexico promised compliance. Yet, in practice, the tension persists. Mexico continues emphasizing protection of native maize and favoring non-GMO corn for staple foods. Trade flows remain strong, worth billions each year, but uncertainty over policy keeps buyers cautious. Processors hedge their bets, sourcing some corn elsewhere. The lesson is clear. Legal wins don't erase political risk. Buyers now value more than legality. They want traceability, residue testing, and verified supply chains. Exporters who provide this transparency keep business steady. Those who can't lose ground. And while Mexico adjusts its standards, a new competitor has already adapted, Canada. Chasing the green premium. Across global markets, sustainability has become the new currency. Buyers no longer ask simply, "What's the price?" but rather, "Can you prove it?" Compliance with land use rules, emission limits, and deforestation bans now dictates trade access. The European Union's climate policies have forced grain traders to adopt satellite tracking and digital audit trails. Shipments lacking verifiable origin risk delay, penalties, or outright rejection. Canada recognized the trend early. Producer groups piloted blockchain-style systems recording every step of grain movement, from seed to silo. These traceability platforms reduce customs friction and meet ESG standards demanded by Asian and European buyers. The result? Smoother clearances, fewer delays, and higher prices, the so-called green premium. The U.S. has similar capabilities, but scaling them across a system designed for volume, not verification, remains a challenge. Until standards align, many importers prefer Canada's ready-made compliance. Trade policy crosswinds. Even the best paperwork can't offset political turbulence. In early 2025, new U.S. tariff rounds and retaliatory threats from trading partners shook agricultural exporters. Analysts warned that a broad trade conflict could squeeze the nation's $190 billion farm export sector, corn included, by raising input costs and deterring foreign demand. Rising freight rates add more strain. Even without tariffs, higher insurance, vessel shortages, and rerouted shipments quietly raise total costs. In such an environment, buyers prize reliability. A traceable shipment with guaranteed clearance is often worth more than a cheaper one carrying risk. Identity preserved and certified cargoes lower downstream exposure, fewer inspection delays, fewer disputes, less red tape. Compliance risk has become a measurable cost in global trade. Exporters who integrate documentation early and diversify markets weather tariff shocks best. Mapping the new corn trade. The U.S. corn export map still starts with Mexico, followed by Japan, Colombia, South Korea, and Canada. But contract negotiations look different now. Importers want digital records proving seed traits, residue tests, and sustainability assurances. Many also demand no deforestation pledges and water use data. Competitive pricing still matters, but documentation speed is now a decisive edge. The new playbook: expand non-GMO and identity-preserved lanes, digitize compliance certificates, and treat paperwork as a strategic weapon. In this system, contracts are effectively won on paper, long before the grain leaves the elevator. Verdict: proof, not price. The United States hasn't lost its corn empire, but the foundation has shifted. Mexico continues to buy heavily, and Asia remains a dependable customer. What has changed is the definition of competitiveness. In 2010, dominance came from scale and freight efficiency. In 2025, it comes from documentation, verified sustainability, traceability, and compliance under every audit. Canada's early move to combine carbon credentials with supply chain transparency has paid off. The U.S. can match, even surpass,